Welcome to Investment Insights by Opal. My name is Jay Coulter, and joining me as always, Austin Graff and Adam Mueller. Let's get right into our topic section. Gentlemen, today Nvidia came out with some interesting news about some new chips. What's your take on its impact for the company?
Look, Nvidia feels like it has like 95% market share in these AI chips. So for them to announce a new, technology, which sounds more like a chip platform than a chip itself, which makes it to me even more impressive, suggests that maybe they can keep the train rolling for some period of time. I can't imagine they're going to maintain, 90%, 95% market share forever. And it's a tricky decision to invest in Nvidia today, given how much the stock has run. But then when you look at the actual projections and the numbers, this isn't internet bubble kind of valuations. It seems pretty reasonable. So it just sounds like Nvidia is continuing to do what it's been doing for the last couple of years in terms of developing AI technologies and considering to push the ball forward, and is the leader in the space.
Yeah, I think given where the valuation is today, obviously there's assumption for some pretty aggressive growth prospect for the company going forward. What we're seeing is, I believe, a demand pull forward, as they're basically telling a lot of customers, you either buy today or you get in the back of the line. And so chips, I think even AI chips are still a relatively cyclical business. We're definitely at some stage of the upcycle right now for Nvidia. And I think the market's trying to figure out how long that cycle lasts and what the downside part of that cycle looks like. Current valuations don't seem to price in a slowdown in growth anytime soon, but I think investors are starting to ask themselves the question, like, is that an accurate reflection of reality, or should we be factoring in something going forward?
And Austin, what do you think could derail this train?
It's going to be a slowdown in growth, in my opinion. So you could slow down growth in a number of ways. One way could be, as Adam referenced, more competition coming in, where it's not the only game in town for AI or generative AI computation. Another slowdown could be just some of the big tech companies who are plowing tens of billions of dollars into these generative AI data centers decide, wait a second, I need to find a way to monetize this business going forward. So maybe I'm not going to spend as much in the future. It will likely be some very small issue that gets blown out of proportion. And we'll see Nvidia kind of trade down and potentially provide a decent entry point for people that have missed out on the trade so far. But it's unclear exactly what's going to cause that decline. It could just be a market dynamic as people say, hey, I don't need chips anymore. And the whole game of pulling forward demand is no longer relevant.
But while we're talking about AI, if I may, it's fascinating to watch the AI sort of evolution or revolution and how it has impacted valuations, how it's impacted the market, how it's impacted individual companies. I think it was also yesterday that the rumor came out that Google's in talks with Apple, and Apple's thinking of licensing Google's AI engine for its iPhones. And Google, already a $1.8 trillion company, going up 6, 7, 8% just on that news. But when you think about it, that could be significant revenue for Google, licensing its AI technology across an installed Apple base of whatever it is, billions of devices. So there's lots of different pieces to this AI puzzle, and it's not just the chips, it's technology, it's software, it's hardware, it's all kinds of stuff.
I think the interesting thing about the Google Apple situation is who pays who. I mean, does Apple pay for access to AI, which it obviously doesn't have internally, and give back some of that payment that Google's been paying to be the default search engine on Apple phones? Or is it going to be the other way around, where Google continues to pay Apple for access to that ecosystem and just ups the ante on what they pay? I don't think it's clear right now where the value is being created and who's going to be paying who for that transaction or that partnership.
Yeah. Interesting, though, of course, Apple stock was also up on the news. So it's interesting. The market's also hasn't really figured out what that what those dynamics are going to look like. Although I think everyone is waiting with bated breath for Tim Cook to just say those two words, artificial intelligence, because everyone assumes it's coming in some way with Apple and that it will somehow be additive. But it could also be that you just have to keep up. That's one of the tricks with picking the winners is some people are going to have to spend money just to not sort of lose market share in whatever they're doing, as opposed to actually using AI to generate, incremental revenue, cash flows, earnings, etc.
I thought the two words you were referencing were the Apple car.
I think that's gone.
I think it is finally dead. Next topic, gentlemen, we can't do a podcast without talking about the Fed and interest rates. According to a recent CNBC study, there are expectations now that they're going to see fewer cuts than originally expected at the beginning of the year. Adam, what's your take?
Wow, that's what a high-tech survey by CNBC to put out a survey that we've all known for months and months. But yeah, I mean, look, the Fed. It does feel like we're closer to cuts than we have been, and it's felt like that for a little bit. But the economy still feels okay. The unemployment rate hasn't spiked. Everything is fine. The real interesting question to me, has any of the decline in inflation that we've seen since it peaked actually had anything to do with the Fed? Or are we paying all these people a lot of money and giving them a lot of airtime and prestige to accomplish absolutely nothing?
Yeah, I was going to say, was this even news? I mean, we've been saying for the last 6 months that the market's overexcited about rate cuts, and it has to do with the fact the economy is doing just fine. It's not doing anything amazing, but it's actually performing quite well. You don't have unemployment in a difficult place. I think the only rational argument at this time for rate cuts, aside from some CEOs going on CNBC and crying about their book, like, over-levered commercial real estate that they can't refinance. The only real issue is the real interest rate. And we're not seeing that truly slow down the economy yet. I think when the Fed starts to see signs of a slowing economy due to higher real rates, then you'll see a pretty quick cut, but I don't see that happening anytime soon. The Fed continues to drive while looking through the rearview mirror, because the alternative is it's actually a much worse scenario, which is they cut and inflation spikes back up and they have a hard time getting it under control. So they want to make sure that they tamp down any potential signs of inflation, and that leaves them kind of holding rates higher for longer.
Yeah, look, like I'll admittedly, I'm in a bit of a prickly mood today, but how hard is it to be a Fed governor? You just look at the 10-year and say that's what rates are going to do. It's not that, it's really not that complicated.
Adam, next topic, Michael Saylor, MicroStrategy. They're holding over 9,000 Bitcoins. Is that prudent stewardship of that firm?
No, it's ridiculous. Whether it works or doesn't work, it's ridiculous. He basically turned his company into an ETF for Bitcoin before the ETFs were approved, and then the stock, just trades like a Bitcoin ETF. And I'd love to be a fly on the wall for those board meetings where they approved that. Like, that speaks to what is going on in corporate governance in America. If you can just take a corporate balance sheet and start buying Bitcoin, are you insane? And why wouldn't every stockholder sell? If you want to own Bitcoin, and that's a whole different debate, just own Bitcoin. Now you can do it through ETFs. It's easy.
Yeah.
Why would you want to do it through some sort of corporate vehicle is beyond me. And it's incredibly poor stewardship. Run a business. Don't buy Bitcoin.
They have a $22 billion market cap and $600 million of Bitcoin on the balance sheet. I guarantee the rest of the business is not worth $21.5 billion. The SEC is going after a bunch of day traders who are using insider trading, overseeing their spouses M&A deal from working at home. Maybe they made 50 grand. They're putting the guy in jail, but they aren't doing anything to Michael Saylor, who's obviously ripping off tons of shareholders. I think the SEC needs to get their act together and start focusing on where the true issues are, instead of trying to put low-level, day traders into jail that, maybe aren't necessarily impacting anyone other than their own pocketbooks in a marginal way.
Yeah, and it's just it just isn't how a company should be run. And if he really, as a person, if he personally believes in Bitcoin, he can buy all the Bitcoin you want. I'm not gonna. I might say I don't think it's a sound investment, but if you want to put your personal finances, into something, and if it works and you become a billionaire, good for you. But doing it through a corporate vehicle like this just seems like it seems disingenuous and irresponsible, and even more than this, irresponsible of the board to let something like this happen. And obviously, they're all in cahoots, to use a technical term.
That is a technical term. Austin, since 1963, it said that housing prices have gone up 2.5 times the inflation rate. Housing is a real issue in this country. How is the next generation of home buyers going to be able to get into the market?
I think it's a great question. I think it's a bit of a leading question because I think if you look at the square footage of homes, it's actually nearly doubled in that time frame. And so when you look at the price versus inflation, you're buying a completely different home. I think, typically, like when I was growing up, you may have like shared a room with a sibling and you shared a bathroom down the hall. And most of the houses that I see these days, I'll have like ensuite baths for all the children. And it seems like everyone's kind of coddled in these much larger houses. And then you get people freaking out about the cost of homes. And I don't know that it's a true issue. I think the bigger issue is the government has a zoning issue preventing new homes from being built, and they're trying to blame it on the Fed because interest rates are high. If the Fed reduces rates to make homes more affordable, all it's going to do is drive up the prices even further because there's a limited supply of housing stock in the US. And if you add more money to throw at that limited supply, all it's going to do is increase the price, which makes it an even bigger problem.
And also, that statistic is exactly the reason why you should try to buy a house, right? It's a great inflation hedge. You live in it. It's for a lot of people, that's their biggest asset that continues to appreciate over over their lives, and often might be the biggest part of their estate that they might leave to their own kids. So it's not like we want that dynamic to change.
The other thing that makes housing a great investment for most individuals is it's one of the few places where you can get relatively cheap leverage on an asset. So if you live in it for a long time, one, you're not paying rent. You're paying, you're going to have to pay some taxes and some interest on your loan, but you get levered growth in your equity over time. And it might not work out every single year, but if you live in a house for 10 or 15 years, it's likely to work out in your favor in a pretty positive way.
I mean, isn't it really just like, if you look, what can you afford to pay in monthly rent, and then use that, and if that was your mortgage payment, back into the house that you can afford at whatever the current mortgage rates are. And if mortgage rates are higher, you're going to afford a smaller, cheaper house. If mortgage rates go down a bit, you can afford a bigger house. Either way, you'd be living within your means because you've set that limit, and then go invest in something and live in it, and it'll appreciate in value over time at a rate above inflation. It seems like a very logical situation.
Next topic, utility stocks. As we're recording this today, the XLU is slightly under its 200-day moving average. Most of the other sectors in the S&P 500 are well above it. What's your take on investing in utilities today? Austin, let's start with you.
I think utilities are a relatively attractive place, mainly because people have used it as a proxy for bonds, meaning it's an interest rate play with interest rates up in the, whatever proxy you use, 5 to 7% range. People are saying, well, I don't need utilities because I can just go buy a bond. The issue with that is it's a backwards looking metric, and the fact that utilities basically grew with GDP for the last decade plus made them look a lot like bonds. But going forward, as we referenced earlier in the podcast, there's a pretty significant boom in AI, which many people may not realize this, but it's a massive power suck on the grid, creating a ton of investment opportunities for many utilities. So utilities are transitioning from an environment where they were growing at GDP to an environment where they're expecting to grow at 2 to 3 times GDP. And so when you look backwards at the valuations of the last decade, they're misleading. They should be much higher. And we think that over time, as interest rates normalize a bit, investors will start to realize that there's a tremendous opportunity in utilities because they're no longer bond proxies. They're now directly linked to growth in AI investment. I think, Warren Buffett didn't do utilities any favors when he wrote in his annual letter that they're almost uninvestable because of forest fire risk. Again, it comes back to regulation and what the government's doing from an incentive for investment perspective. They're disincentivizing utilities to invest in expanding the grid at a time when they need grid expansion more than they need anything else.
Yeah. Adam, any thoughts on utilities today?
Well, just in general, like the lack of investment in U.S. infrastructure, including the electric grid, is just becoming more and more of a topic that you hear more and more often. Wouldn't surprise me if it becomes a political topic through the election cycle as well. And it's a small draw on like the move towards electric cars requires electricity. Let's get rid of everything that's like fossil fuel based and everything should be electric. Well, yeah, but the electricity still has to come from somewhere. And I think that's small potatoes in terms of the draw versus what AI chips potentially represent. But the broader point is that utilities, the grid, electricity is becoming a bigger and bigger topic that more and more people are talking about more and more often. And eventually that will filter through into the utility stocks, catching a bid. And then we'll get a golden cross and I'll be able to say my favorite line on the podcast.
Yeah, if we're going to transition from carbon-based energy to green energy, there's only one transmission mechanism that we have to date for distributing that energy, and it's utilities, right? So if you're just thinking GDP growth, you're either saying that you think that carbon energy is going to be a tremendous driver for the economy going forward, and the government's not going to succeed even remotely to their desires in the green energy movement, or you're saying that there's going to be some reduction in the economy.
Austin, we'll talk about Nextera in the bull or bear segment. Let's go to our next topic. Junk bond defaults are starting to surge again. What do we need to be looking out for?
Yeah, I think you need to be looking for, coverage metrics or interest coverage metrics when you're looking at companies. You need to be forward looking instead of backwards looking for many of these metrics. I think you also need to be steering away from some of the shakier parts of the economy. The consumer's been holding up relatively well. We've seen some beneficiaries from government spending, whether that be infrastructure plays or that be some of the AI plays. But there are certain sectors of the economy that have struggled, mainly retail, that, it's more of a consumer preference versus a consumer requirement. Even some of the consumer requirements are struggling. If you look at some of the dollar stores, whether that be Dollar Tree or Dollar General, they're having a hard time because the SNAP program was reduced significantly midway through last year. So there's a lot of puts and takes in the economy right now. You need to be careful that you're not getting exposure to areas of the economy that the government's pulling cash away from, and focus on the areas where the government's pumping cash in, because it's becoming more and more apparent that the government is dictating winners and losers in the current economic environment.
Does it ever make sense to have a junk bond allocation in your portfolio if you're a long-term investor?
I think if you're a long-term investor and you were to invest in a handful or even a couple of handfuls of junk bonds, you're going to do well over time. That being said, you might have one or two losers in the mix. You need to make sure that the bonds that you own, as we said before, have decent interest coverage, but also have good asset coverage. So to the extent they're asset-based loans, you want to make sure that if they do go into default, you'll at least be able to recover some of your money if the assets need to be liquidated to pay off the debt.
But I mean, I would just add to that you you remember when interest rates first went up, right? And we talked about how a lot of the larger cap investment grade companies were smart enough to term out a lot of their debt before the interest rates really spiked. So there was no near term either refinancing issues or increases in interest expense that could, really shock the system. But now some time has passed, and I can't help but wonder if junk bond defaults are surging, and those are companies where it's a little harder to get financing. They're not investment grade, obviously. They're junk. So you wonder, could this be the canary in the coal mine that says that these high interest rates are finally actually having an impact? And is this one of those the first or early sign that the economy might turn over in the next 6 to 9 months? Maybe, but I think it's definitely something to watch.
Yeah, Adam's referencing, one of the other things that I didn't mention, which is just pay attention to maturities, right? So if you have a junk bond that is, paying something like 5% because it was issued in a 0% interest era, if it gets refinanced at 10%, and the company doesn't have significant cash flows to pay for that additional debt, there's likely going to be a credit event. It might not be a positive credit event as a holder. That being said, a lot of these situations will be worked through. It sounds like the banks are already starting to work with some issuers to make sure that there aren't any kind of hiccups in the system. I think people have been talking about the maturity wall in junk bonds for the last decade, and it keeps getting pushed out another year, another year, another year. So I'm hesitant to say, hey, there's this massive maturity wall, but it is something that investors should have in the back of their mind that it could become an issue to the extent there's a number of these maturities piling up that can't be restructured.
Let's switch gears to small caps. For investors, the last 3, 5, and 10 years have seen large caps dramatically outperform small caps. So in a diversified portfolio, you're looking at some real underperformance for a really long period of time. Does it still make sense to allocate to small caps given what we've experienced the past decade?
Probably makes more sense than ever to allocate to small caps. I think the one thing you need to watch out for is you need to watch out for high levels of leverage, and you need to watch out for profitability. One of the downfalls of like the Russell 2000 is you have a lot of unprofitable firms in there. You also have a lot of financial firms that have significant amounts of leverage. And so just saying like, hey, all small caps are cheap is a difficult argument, but there's definitely some opportunities in the small cap space as the market's been infatuated with, a handful of companies that are the largest and supposedly, best companies in the world. That's going to normalize out at some point, and you should see some broadening in the market. We've already started to see some of that in the first few months of the year. That should continue, but you need to be selective in small caps.
Yeah. This really seems like a great opportunity for active management in that space, for sure. So, Adam, Steve Munchin is interested in TikTok. Would you be?
Did you say Steve Munchkin? The Oompa Loompa is at it again. That's what an interesting guy Steve is. Former Goldman Sachs partner taking advantage of dislocations in the market, really. And what is like the TikTok situation is fascinating because if the U.S. government effectively says ownership of this needs to be sort of U.S. based, and ByteDance, the Chinese company that owns TikTok, and I heard a number floating around that it which I think is probably low, is that it's worth at least $50 billion. So, and I think that's for the sort of U.S. piece of it. They'll sell. Like, why wouldn't they sell? You don't want a $50 billion asset to go to zero. And it sounds like Steve is positioning himself with some other investors to try to capitalize on that. And whenever there's a forced seller, which in this case would be ByteDance, if the U.S. government says that TikTok can't be run by a Chinese owner, whenever you have a forced seller, it's a fantastic opportunity for someone to make a great return. Warren Buffett in 2008, 2009, and buying the warrants in Goldman and B of A, like they were essentially forced sellers in the sense that they needed capital infusions, and from a reputable source, and Buffett was able to do that at terms that no one else could get. And this feels like maybe it's a similar type of situation, and not like what the Oompa Loompa did with NYCB, New York Community Bank. Right, that bank was needed an infusion of capital, needed it fast, and he was able to come in and put a significant amount of money in, and it wouldn't surprise me at all if in the next 3 to 5 years he makes an incredible return on that investment. The real question in TikTok is, will other bidders emerge? And because it's sort of a trendy, sexy kind of name, is someone going to show up that actually overbids because they just want the not in a similar way to like Elon Musk just wanted to own TikTok until he didn't, of course, but then it was too late. But there's a PR element of owning an asset like a TikTok, and so someone might show up and overpay. But for right now, it sounds like Steve is positioning himself to own a really interesting asset.
I question what's the value of TikTok if it's an algorithm, right? So if you don't have the algorithm or you don't have all of the code that they have in China to run that thing, like, is it still worth what it's generating? I don't even know how that works, but it seems like it's a question that someone's going to have to answer as they try to figure out how much they pay for that thing. I would think that Oracle would be a front runner in that because that's where the data is being stored. A couple of years ago, they forced TikTok to store all the data in the US, and Oracle partnered with TikTok. So I would think Oracle and Larry Ellison's going to have to play a role in that somewhere. But I still don't know. I don't even know how you value something like that, where it seems like the secret sauce is still going to be sitting in China.
Well, what a fascinating situation that has so many kind of ethical strings attached, where the government is saying, "Hey, TikTok, you got to divest your American business," and then other let's say high profile political people are saying we can't let it just get shut down because then Meta, Facebook, will be too powerful. And Meta, not unlike when Bill Gates, helped Apple, because you needed to make sure that you had a viable competitor, or you were at risk for sort of antitrust issues and monopoly issues. So there's a lot of different things going on with this, and it'll be very interesting to see how it plays out.
It's also classic that we have a former government official going to offer their assistance in a deal that's being forced by the government. It reeks of compliance issues, but we'll see how things shake out.
Yeah, it's a little window into how the world actually works.
I'm sure this will be a topic that will come up a lot between now and the election on future podcasts. Let's shift to our Bull and Bear segment, our most popular segment because you only get 60 seconds to answer the question. Austin, we're going to start with you. Bull or bear on GE?
The stock's up a lot, but I'm still a bull as they're currently spinning out their electric generation business in Renova. I think that there's a lot of opportunity there. As we referenced before, there's a tremendous demand for energy in this country, and GE, particularly the spun-off entity, is going to be a huge beneficiary of that. They also have a jet engine business, which I don't know if you've seen the news recently, but there's a tremendous demand for passenger jets, and they're one of a few suppliers in that space as well.
Adam, bull or bear on Broadcom? I'm a bull on Broadcom, and not just because of the AI pull that has impacted a lot of the chip stocks, but also remember that they own VMware and they're integrating that acquisition, and that's huge for them. But also, even before the sort of AI stock surge, the chip cycle was bottoming out. So you've got the AI piece, but then you also just have the natural chip cycle, which is working in their favor. So they've got 2 or 3 tailwinds right now, which should serve them very well over the next 12 to 24 months.
Austin, bull or bear on United Health?
I'm a bull on United Health. They've been dealing with some issues recently, whether it be reimbursements from the federal government or whether it be medical costs from, I would say, older Americans going in for elective surgeries again. And the final kind of issue has been the hack that prevented Change and Optum from paying a number of healthcare providers across the country. It seems like there's a number of negative news items that are kind of clouding the name, but it's still a very strong business at a very reasonable valuation, given the growth profile and the underlying business there. So I'm a bull on United Health.
Adam, bull or bear on McDonald's?
I'm a bear on McDonald's, and not because they had a technology outage earlier this week. That was a minor glitch that made for good headlines. But more because as the economy continues to do well in stretches, we are getting a recession will happen again. And I think the people that are starting to feel any strain in the economy and will continue to feel it first are the sort of lower income consumers that are the bread and butter of McDonald's customers. So I don't see the next 12 to 24 months setting up well for McDonald's.
Austin, bull or bear on Nextera?
I'm a bull on Nextera. It's another name that's got kind of some clouds over it, but it's got an extremely strong underlying business. One of the clouds just started to dissipate, being they were being investigated for election rigging in the state of Florida, and that was just they were just kind of cleared of that. But they've also had issues with their green energy development company potentially growing slower than previously expected. It's not an issue for the parent company. It's still going to grow at a double-digit rate at attractive valuations. As interest rates kind of normalize, we think it could be a huge tailwind for a company that has tremendous growth prospects in a great market going forward.
Adam, bull or bear on Disney?
I'm a bear on Disney, and they're going through this proxy battle right now where Nelson Peltz wants a couple seats on the board, and to me that's we'll see how that plays out. George Lucas supported the current board and Bob Iger, and I couldn't care less what George Lucas thinks. He is one of the largest shareholders because he got shares when he sold Lucasfilm to Disney, which is why it matters. But the reality is that they're suffering along with all the other companies that were valued based off of streaming subscribers. Bob Iger came back to try to save the day, and the stock had a nice little run up on him coming back. But I think it's a show me story still, and it doesn't scream cheap. And there's only so much pricing power in the parks before people struggle to go. So I think in the current where we are in the economic cycle, I'm a bear on Disney.
Austin, Adam, thank you for your time today. Viewers, to learn more about Opal Capital, visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.